Hello, I'm Ram Singh. I'm Professor of Economics at the Delhi School of Economics. Today I'm going to be talking about goods and services tax. As you know, goods and services tax was implemented in 2017. It has recently marked 2 years. And it has been news since it was introduced. Popularly, this tax is called GST, acronym for Goods and Services Tax. It is an indirect tax as opposed to income tax, which is a direct tax, but GST is an indirect tax. It is imposed on goods and services. So specifically, it is a value-added tax. So we will be in the talk today. I will be discussing the meaning of value, the definition of value-added tax, exactly how it is implemented, levied, and how it affects production processes. I will also talk about in which ways GST is better than the tax regime we had before GST was introduced. So to simplify, our agenda today is to discuss GST, to talk about how it affects the production supply chain, how it's going to affect the revenue collection, and we will also discuss implications of GST for the taxpayers, for the government in terms of tax collection. But more importantly, I will be focusing on the economic dimensions, economic effects of GST. I will be showing you that GST leads to more efficient outcome. It is an efficiency enhancing tax. So let's start by describing some features of GST. It is a tax that fits in the scheme or vision of one nation, one tax. Before GST was introduced, every state had its own tax structure. That means that anybody doing business in India had to have arrangements, had to comply with tax regimes, tax administrations for different states. That's like if you do business in 30 states, then you have to deal with 30 tax regimes. After implementation of GST, that process has been simplified. So if you produce one good, then you deal with one tax. In that sense, it's one nation, one tax. In this process, it also has integrated market. So for GST, our country was divided, our economy was divided in sub-economies. Now we are a unified economy in terms of as far as tax and tax compliance is concerned. GST subsumes various taxes that were in place before GST was introduced. So before GST was introduced, there was sales tax, there was octroi, there were excise tax. All these taxes have been subsumed and simplified and converted into a single tax, GST. So GST, however, has three leading forms. So the one is state GST, other is center GST, and third is interstate GST. And GST has added feature that its returns can be filed online, and the government is in the process of simplifying filing of tax returns easy for the taxpayers. So briefly put, it has added to economic unification of our country. Before we discuss how GST actually is implemented, by way of contrast, let's start by discussing how taxes were implemented before GST was introduced. So in this example, we think of a manufacturer, producer. So suppose producer produces an output. To produce an output, the producer uses some input. So the value of input, so the price of input paid by manufacturer, we assume that to be 10,000. we are using fictitious examples, so these numbers are chosen for simplicity to make the point in a simple way. So we assume that the producer uses input that has value, the price 10,000. Now suppose if there were no tax, imagine a situation where there is no tax at all. And suppose the producer, after producing, so our producer has bought an input worth 10,000, and suppose our producer is going to sell it in 11,000, which is to say by adding 1,000 to it, if there were no taxes at all. But in real world, there are taxes. In the past, one of the taxes was excise duty. So let's assume that excise duty was implemented at 10%, and the excise duty would be levied on 11,000, which is the price, sale price for our manufacturer if there were no tax at all. But since there is a tax, to repeat, so the excise duty will be levied on 11,000, which is 10,000 the cost of input plus 1,000, which we call value added. So excise duty levied on 11,000 would mean that the tax comes out to be 1,100, 1,100. So under old scheme, there were multiple taxes that were levied at a single stage of supply chain. So other tax that was frequently used was value added tax. So and the value added tax was imposed not on 11,000 but the value we get after factoring in excise duty, which is to say that the VAT will be imposed on sum of 10,000 cost of input plus 1,000 value added plus 1,100, which is the amount of excise duty. So as a result, value added tax at 10% comes out to be 1,210. So our manufacturer is going to sell after paying these taxes. The sale price for our manufacturer turns out to be 13,310. And our manufacturer in our example is going to supply this good to a wholesaler. So in other words, the wholesaler purchases the unit, the product, at a price of 13,310. And suppose our wholesaler would like to sell this product to a retailer by charging 1,000. So 1,000, simply put, we call is value added on the part of wholesaler or at the stage of wholesaling. So again taxes will come in. The value added tax paid by the wholesaler would be levied on the purchase price. Purchase price for our wholesaler was 13,310 and markup or value added is 1,000. So as a result, value added tax comes out to be 1,431. So that would mean that our wholesaler will sell this product to retailer at a price of 15,741. And again, to keep things simple, we assume that retailer also is going to add 1,000 as a value to the product. In other words, if there were no taxes to be paid by retailers, the retailer would have sold this product at a price of 16,741, which is 15,741 his purchase price plus 1,000 value added or markup or loosely speaking profit at this stage of retailer. So in that world, if there were no taxes paid by a retailer, then the product would have cost consumer 16,741. But there are sale tax, so there were sale taxes, and sale tax at the rate of 10% will lead to the price increasing by 1,671 and value added tax over and above sale tax. So as a result, the total price comes out to be 20,257, as you can see from the table. So to repeat, so if we were to discuss the value addition in this entire supply chain, value addition, so to revisit, the value addition is only 13,000. Why is it only 13,000? So the value of input was 10,000 and value addition at the stage of manufacturing was 1,000. That makes total value addition at this point 1100. Then there was value addition by the wholesaler worth 1000, and final value addition on the part of retailer again worth 1000. So this adds up to total value addition of 13,000, but the price comes out to be much more. So price comes out to be 20,257. So, and this remaining amount, which is 7,257, is actually tax. It's a sum total of taxes that were paid. Also here we should notice that the taxes were imposed under old system on taxes themselves. For example, VAT at the stage of manufacturing, VAT, value addition tax, was imposed over and above excise duty. So similarly at the stage of retailing, VAT was imposed after including over and above sales tax. So now this regressive nature of taxation, which is taxes on taxes, this problem has been done away with by GST. How GST solves this problem? Well, so GST subsumes, as we discussed in the beginning, GST subsumes different taxes and replaces all these taxes with one tax. So at one stage there is only one tax that is to be paid. And GST also has a feature of input credits, so that we will discuss, that leads to better compliance with the tax regimes. And GST is a value added tax. It is tax only on the value added. It is not tax on taxes, as we will see. So here on this slide you can see the supply chain under GST. So you should notice, we can notice two features on this slide. For one, that at every stage in the supply chain, only GST, that is only one tax, is levied. Multiple taxes are not levied. Two, so if you, for instance, if you think of a manufacturer, then there are two arrows that point towards GST from manufacturer. Similarly, there are so this would mean that on one hand our manufacturer will pay the tax, but will also get input tax credit, as we will see shortly. So let's now use an example to discuss how GST is levied in contrast to the earlier tax regimes. So now we revisit the same scenario, that is that we revisit our manufacturer that had bought input worth 10,000 and added value worth 1,000. So now GST has, since GST is so including the value of input and value added by the manufacturer, the number we get is 11,000. So at the stage of manufacturing, the total value added till the stage of manufacturing, the total value added is 11,000, and GST is tax on value added. So 10% of 11,000 comes out to be 1100. So under GST, sale price of manufacturer will be cost of input plus value added plus GST. It will come out to be 12,100. So the sale price for manufacturer is the input price, is the purchase price for wholesaler. That means for the wholesaler, cost of the product is going to be 12,100. And value addition, value added by the wholesaler is going to be, by assumption, it's 1,000. Now we bring in GST. So at the stage of wholesaler, the value addition is only 1,000. It's important to notice several features of GST. So for one, at each stage the tax is imposed on value addition. So it's worth paying attention that at the stage of wholesaler and retailer, value addition is 1,000 each. But at the stage of manufacturer, by assumption, the combined value addition is the value of input plus value addition by manufacturer. That is why at the stage of manufacturing, the value addition turns out to be 11,000, and thereby GST is imposed on 11,000. So, and that's why GST collection will be 1100. All right. So So for our illustration, we are going to use example of wholesaler and how wholesaler will benefit from the provision of input tax credit. So in our example, so remember the wholesaler purchased the product by paying 12,100. Value addition by the wholesaler is 1,000. As a result, the sale price, pre-GST sale price comes out to be 13,100. GST is, so let's see how GST actually is calculated. So GST at the rate of 10% would mean that the wholesaler will deposit tax which is equal to 10% of this amount, 13,100. So that's the amount our wholesaler will have to deposit. But our wholesaler is going to get input tax credit. What is that input tax credit? Remember, input price, purchase price, the cost for our wholesaler was 12,100. That's the price our wholesaler paid to manufacturer. So, and manufacturer had paid 10% of this amount as a tax to tax authority. So our wholesaler is going to be reimbursed to the tune of 10% of 12,100. So the amount 10% of 12,100, that amount is nothing but input tax credit that will be enjoyed by our wholesaler. So as a result, if we see the net GST paid by our wholesaler, it's going to be 10% of 1,000. And what was 1,000? 1,000 was nothing but the value added by the wholesaler. So in that sense, we can see both things simultaneously. On one hand, GST is taxed only on the value added by the wholesaler. At the same time, we can see how input tax credit is going to be enjoyed by the wholesaler. And other thing we should notice is that for our wholesaler to enjoy input tax credit, it is important that manufacturer has paid tax to tax authority. So in other words, so if our wholesaler wants to enjoy input tax credit, it becomes difficult or impossible for his supplier, who is his supplier, manufacturer. It becomes difficult for manufacturer to evade tax. So that's other advantage of GST. Through input tax credit, on one hand, provision of input tax credit makes sure that tax is imposed only on the value added and it doesn't become regressive. At the same time, it improves compliance because then it becomes so difficult for the manufacturer to evade tax. And same logic will apply if we were to focus on retailer. So input tax credit by the retailer would mean that the wholesaler has to pay the tax. And if our retailer wants to enjoy the input tax credit, then the wholesaler, it becomes difficult for wholesaler to evade the tax. So that is other advantage of GST. Let's now briefly talk about different tax slabs under GST. What are the prevailing GST rates for different products? So GST is a kind of progressive, loosely speaking, it's a progressive tax in the sense that the tax rate on necessities, food items, items that qualify as necessity for masses, they invite lower tax rate, and most of those items fall under the tax slab of 5%. So then we have different tax slabs. 12% tax is imposed on apparels, computers, and processed food, butter and cheese, etc. So 18% is the standard, is the standard tax rate, GST tax rate, and it covers most of other things. So it includes cameras, salads, ice creams, and many other capital goods or industrial goods that serve as intermediaries invite a tax of 18%. And the highest tax slab of 28% is reserved for luxury items such as cars, consumer durables like air conditioners, refrigerators, and so on and so forth. So in this sense, GST is a progressive tax. So overall, poor are taxed at consumption by poor is taxed at a lower rate than the consumption of riches. So having described various features of GST, let's now talk about economic efficiency of this tax regime. One major economic gain is going to come from the unification of Indian economy. So as we discussed in the beginning, this tax regime adds to unification of Indian economy. It also reduces logistical cost, the transportation cost for producers, for buyers, for sellers, purchasers, and thereby it reduces, so by reducing transportation cost, it is expected to bring down prices and thereby benefiting the consumer. So earlier on, you might have noticed that at every state border there will be long queue line of trucks waiting to enter from one state to the other. Now that has disappeared with advent of GST. The octroi have been done away with. The octroys have been subsumed under GST. It is expected that that freight will move from one state in India to other state by taking less time and thereby reducing transportation cost in the process. So both money cost, the cost of fuel spent on transportation, and also time spent, both will come down. As a result, the logistical cost, transportation cost will come down, making goods cheaper. And not only that, actually GST is expected to enhance, to promote, to incentivize more production. If production increases, that would mean that supply of goods and services will increase, and for any given level of demand, increase in supply would mean that prices will come down, again benefiting the consumer. So let me spend some time on describing how GST is also expected to incentivize more production, is also expected to incentivize efficient production. And for this purpose, I am going to use very elementary tools of mathematics, very simple functions that all of us in economics are familiar with. So let me describe basics of the model I am going to use. To keep things simple, think of a producer that uses one input to produce one output. So the input will be denoted by X. So by X, so X will stand for input used by the producer. And the output is given by production function, and the production function we will use, as you can see on the slide, is F. F is the production function used. So F of X will stand for the output produced corresponding to the amount X of input used. So in the notation you also see on left hand side, F depends on X input. Naturally the output depends on input, so we would expect function F to be increasing in X. But there is other variable K there in the function. So by K we denote the capital. The capital could be machinery, it could be building, it could even be human capital that is used in the production. So simply put, our production function, our production involves input X. Input X is purchased by somebody else, and K, so on top of, in addition to X input, our producer has to use plants, machineries, and maybe his or her own human capital. As a result, output produced will be F, that depends on X and K. But for simplicity, in the interest of simplicity, we will assume that K is given, is fixed. It is some number of hours provided by our producer. It could be the plant and machinery that is already in place. So only in the interest of simplicity, we are assuming that the output depends only on the use of input, because K, the capital, is fixed in supply for our producer. And again, in the interest of simplicity, we will think of a competitive, we will assume competitive setting, we will assume only in the interest of simplicity that the market, input market and output markets are both competitive. So that means that the price, input price and output prices are given for our producers. I would like to emphasize that the conclusion we will reach at does not depend on these assumptions. It's only in the interest of simplicity to drive home, to learn about functioning of effect of GST in a simplest setting, we are making this assumption. So we will, by small p, we will denote the output price. But there is a competitive market in the input also, input X. The per unit price of input X is given by C. So small c will stand for per unit input price. So in this setting, let's now write down expression for value addition. So what is the, how can we write value added by this producer? Value added, let's denote value added by capital V. Value added will be written as the value of output. What is value of output? Value of output will be price of output, per unit price of output multiplied with quantity of the output produced. And what is that quantity? F of X. So here, for simplicity, I have ignored K because we are assuming K is a given fixed amount. So the quantity, the amount of output is given by F of X multiplied with its price, output price gives us value of output. We deduct value. So from this we deduct the price, the cost of input. And what is the cost of input for our producer? It is the quantity of input used is X multiplied with its price, which is C. So C of X becomes cost of input. So as a result, value added by the producer is given by a difference of what you can call revenue minus cost, or P of the first term, that is revenue minus the cost of input. On the other hand, the profit, how will we write profit? So profit, so value addition is not equal to profit. In the discussion so far, I was using value addition and profit interchangeably, but to be sure, we should make a distinction between profit and value addition. So profit for our producer will be given by revenue minus cost of input minus cost of K, even though K is assumed to be fixed, but it costs something. And suppose the cost of K is K itself. So the profit will have a different term. So to determine profit, we will have to account for K also. So when we talk about value addition is profit plus something plus an extra term. Here extra term is K. So from 1 and 2 we can see that value addition and economic profits are different. So value addition is more than economic profit, and remember GST is tax on value addition. So it's not, strictly speaking, it's not tax on profit, it's tax on value added. So under GS, so first of all, before we talk about output produced by producer under GST, let's try to find out what will be the ideal output, what from social viewpoint, what should be the output produced. Or in other words, we also can say that we can also ask a question, if there were no taxes, what will be the output produced? If there were no taxes, then for our producer, the maximization problem will be maximize revenue minus cost minus all the cost. So maximize profit. And this maximization problem will have a solution that we are assuming that solution is identified by the first order condition given here. So here you can say P time F prime is marginal revenue and C is marginal cost. So the solution will be given by the standard equality marginal revenue equal to marginal cost. And suppose that solution is X star. So X star is the output level that our producer will produce if there were no tax at all. And it also, So it also happens to be equal to marginal revenue equal to marginal cost. So this happens to be profit maximizing in the absence of any tax whatsoever. So if we take our functional form for f to be x raised to power theta, and theta is a number strictly between 0 and 1, then we can get closed form. We can get neat expression for x star, the profit maximizing output level, that will be as given in expression 4 here. We have seen what is that our producer will do, how much our producer will produce if there were no taxes. In economics, we know it very well that taxes generally are distortionary. They distort production level, they reduce efficiency of production level, they reduce efficiency of consumption levels. But here we will see that GST has a feature that makes it non-distortionary. It does not contribute, it does not cause distortion. Let's see how that happens. So remember, under GST, suppose we assume that GST tax rates are T superscript G for GST and T for tax. So TG would stand for tax rate under GST. We have seen that there are different tax rates for different products under GST. So in general, we denote tax rate under GST by TG. So, and remember, our GST is a tax on value added. So how much tax will be paid at any stage? So tax paid by the entity will be T tax rate multiplied with value added V. So writing expression for V, so TG time revenue minus cost, and we can write it as we have written it in expression 5. So but here important point to note is that the tax paid will be T time a TG fraction of V will be paid as a tax by the entity, by the producer. And our producer will also get input tax credit. What will that be? So in terms of formal notation, it's going to be T time of input cost, so which is TG multiplied with CX. So that will be input tax credit that will be enjoyed by producer under GST. In contrast to this, under old regime, there was no input tax credit, but there was a tax on the output or on the sale. So loosely speaking, under the old regime, tax was under TO for old regime. So TO tax rate under old regime was imposed on the entire output or value of the output without giving any input tax credit. That changes everything. How that happens? Under GST, remember, under GST, our producer is going to pay TG fraction of value added as a tax to government. Therefore, our producer is going to be left with 1 minus TG fraction of the value added for himself, for herself. So as a result, for maximization problem of producer under GST will be written as 1 minus TG, that's the fraction of value added he gets to enjoy, will be times value added, which is revenue minus cost, minus, since we are considering profit maximization exercise for our producer, so minus cost of capital minus F, where F stands for fixed cost under GST. What are these costs? What do I mean by fixed cost? What do I mean by capital F cost? So under, if any producer has to comply with the GST, there are compliance costs. There are records that have to be kept. The transaction details have to be submitted on regular basis to the tax authority. All these costs are denoted by capital F. So as a result, this becomes profit maximization exercise problem for our producer can be written as we have done here. So remember, by assumption K is a fixed number, F is also a fixed quantity. So they do not affect the choice. They will not affect optimum choice in terms of X. So if you use functional form that we have, so you will get, I leave it to you as an easy exercise that the optimum level, the profit maximizing level under GST will be as it is given under 6. And this level of output produced, which is profit maximizing level of output produced by chosen by producer, is nothing but the output level in the absence of tax at all. In other words, the output level chosen by profit maximizing producer under GST is same as output level she will choose in the absence of any tax whatsoever. So therefore, GST causes no distortion. However, GST has some implications that we should be mindful of. To briefly put this point, the other implications of GST. So suppose under old regime, think of a small firm, a small producer, and suppose this small producer under old regime was earning profit pi o, and pi o, how do you can say that pi o can be written as 1 minus t of the revenue. The rest of revenue went to government in the form of taxation. So this much was left with the producer minus her cost. So pi o, suppose pi o was a profit enjoyed by a small producer under the old regime, pre-GST regime. Under GST, the same producer, small firm, will incur different profit. They will be different because the two tax rates are different. The basis of tax is different. GST is tax on value added. So under GST, however, our small producer, any producer, has to incur additional cost, which is compliance cost, which we have denoted by F. Now, if F is large compared to profits earned by a producer, then total profit under GST can be less than the profit enjoyed by this producer under pre-GST regime. And this is a concern vis-a-vis small firms, small producers. So for small producers, GST can reduce their profitability and thereby can undermine their chances of their survival in a market setting. To sum up, under GST, if a firm survives, it will produce more efficiently. But for small producers, there is a risk that they may not survive at all on account of large compliance cost. It is to address this issue, this concern, that government has introduced what is a scheme called composition scheme. Under composition scheme, the government firm does not have to incur compliance cost because it is exempted from GST altogether. So the composition scheme is meant for small players, small firms, and under the scheme, small producers are exempted from GST. That in turn means that they can continue to survive in the market, even though they will be producing less efficiently. To sum up, we face a trade-off between more efficient production versus chances of survival. But as compliance costs come down, then it will be possible for us to move a larger set of firms into GST mold without risking their chances of their survival. With this, we conclude our discussion today. Thank you so much.